In the Forex market, price doesn't move randomly. Behind every major trend, every violent move, or every prolonged consolidation, there's a force every trader must learn to respect. Central banks. Understanding how decisions by the Fed, the ECB, and the Bank of Japan impact currency markets is not advanced knowledge. It's survival, all right? Those who ignore this trade in the dark. Those who understand it trade with context, not guesswork. I'm Chad. I'm a presenter here at Zero Markets, and I bring you valuable insights every week based on analysis from our experts. Forex is, at its core, a market driven by macroeconomic expectations. So when you trade a currency pair, you're not just looking at charts, you're comparing economies, monetary policies, and global capital flows. That's why interest rate decisions, speeches, and shift in tone from US, European, and Japanese central banks have an immediate and direct impact on prices. The Federal Reserve is the main engine of this system. When the Fed signals a rate hike or a cut, the dollar reacts because the market recalculates return, risk, and capital flows. Higher interest rates tend to strengthen the dollar, while signs of monetary easing usually put pressure on it. But the most important point isn't the decision itself, it's the expectation built ahead of it. In the US market, traders who position after the announcement are already too late. The European Central Bank enters the equation as the counterbalance to the dollar. See, the ECB decisions directly affect pairs like the euro to US dollar, but they also influence global risk sentiment. When Europe signals weak growth or lower rates, the euro loses strength and capital tends to migrate towards assets perceived as safer. The attentive trader understands that it's not enough to analyze one central bank in isolation. It's the difference in stance between them that drives Forex. Now, if you made it this far in the video and the content has made you at least 1% smarter, please like this video so that YouTube understands that you want to receive more of this kind of content. And subscribe to our channel to stay up to date on everything about the market. The Bank of Japan, on the other hand, plays a very unique role. See, Japan has lived for decades with extremely low interest rates, which turns the yen into a funding currency. When the market is confident, the yen tends to weaken. When fear emerges, it strengthens very rapidly. Even subtle changes in the Bank of Japan policy often generate abrupt moves, especially in pairs like the US dollar to the Japanese yen. The most common trader mistake is treating these decisions as isolated events. See, in the professional market, the focus is on the cycle. The Fed may be tightening while the ECB hesitates and the Bank of Japan maintains stimulus. This asymmetry creates clear trends in FX. Those who understand this game don't trade the news, they trade the context. They use charts for timing, but macroeconomics for direction. In Forex, charts show where the price is, but central banks explains why it moved. Decisions by the Fed, the ECB, and the Bank of Japan are not noise. They're the map. If you want to stop reacting to the market and start anticipating moves, you need to learn to read monetary policy like a strategic trader. Now, if this content made sense, hit the like button, subscribe to the channel, and comment below. Which central bank do you believe has the greatest influence on Forex today? In the next videos, we're going to keep breaking down how the global market really works, with no shortcuts and no illusions.